welcome back to EduTap and welcome to Finance Current Affairs session. In today's session, we are going to have the complete analysis of the Financial Stability Report. That is a very important report from the exam perspective. In the previous year of the RBI Grade B, there was a direct question in the descriptive of the phase 2. So you can understand that how important the FSR is. Okay. As well as there is the systemic risk survey also that is there in the Financial Stability Report. That is also we are going to do in today's session. So let's have the complete analysis of this Financial Stability Report. But before starting with this very important report and the systemic risk survey, there is a big announcement from EduTap that we have brought for you the complete guidebook for RBI, NABARD and SEBI. So through a single guidebook, you can get all your common queries answered. If you want to know about the examination, that what is the pattern of the exam, what is the syllabus for the exam, what are the previous year cutoffs for the examination, all of these information you can get through a single guidebook. You do not have to visit different links. You do not have to visit different websites. Even if you want to know about the preparation for the examination, that is what should be the sources for the preparation, what should be the strategy for the preparation, all of these information is provided here and the definitive answers are provided. So do download this free guidebook that is made absolutely free of cost to save your time, to save your efforts, and this is easily available. You can easily download this. The link is given in the description box below. So do download these guidebooks. Okay, these are going to help you a lot in enhancing your understanding for the examinations. So now starting with the Financial Stability Report, we have already discussed the two chapters of the Financial Stability Report. That is, the first chapter was regarding the macro financial risk. That is the risk that is coming to the global financial system and the risk that are coming to the Indian financial system. Then we studied about the financial institutions, the soundness and resilience. That how sound they are, how resilient that they are, and we saw it through the data regarding the capital buffers that the banks are keeping, like the CRAR, the profitability that the banks are having, the asset quality that we saw through the gross net non-performing assets and through the net non-performing assets. So we saw that how resilient and sound the financial institutions are as they have good capital buffers, as they are having good profitability, enhanced profitability, and they have good asset quality, that is their non-performing assets are decreasing. Okay, so these two chapters we have already done. And what is FSR? I have told you this is a semi-annual publication, that is in a year it is released twice. Okay, and this is the collective assessment of the Financial Stability Report is the collective assessment of the subcommittee of the Financial Stability and Development Council, that is chaired by the Governor of the Reserve Bank of India. And the FSR shows us the risk to the financial stability and the resilience of the financial system. And this is the 26th issue of the Financial Stability Report. So this is all that you need to have the brief understanding. First, what is FSR? Then the chapters. Okay. So the global economy, the risk that it is facing due to Russia-Ukraine war, due to the COVID, the risk came. Okay, and all the international bodies, they have downgraded the global growth projections. So this was the main idea. In the Indian economy is also confronting strong global headwinds. There is global spillovers that is happening. The external spillovers due to the Russia-Ukraine war, due to the COVID. Due to the COVID, there was supply chain disruptions, and due to which the growth was reduced. And now due to the Russia-Ukraine war, there is high inflation that is coming. So there is external spillovers are coming. But the Indian financial system, the macroeconomic system, it has a very good foundation. Okay, due to which the asset quality is good, the profitability is good, the liquidity buffers, the capital buffers are good. So these are providing a good fundamental, a good foundation to the macroeconomic situation of our country. Okay, due to which these trends are helping the financial system weather the stand against the external spillovers, stand against the tightening in the global financial markets, and stand against the high volatility in the financial markets. Okay, so the good fundamentals that we have, that is the good asset quality, the good profitability, the good buffers that we are keeping, as well as the steps taken by the monetary authority and the steps taken by the government. These are the things that are keeping the Indian system good, the financial system good. This is all that we have discussed in the previous session. Okay. Next we discussed about the data points. Here you can see the scheduled commercial banks that we have came to a 7-year low in the non-performing assets, gross non-performing assets. We have came to a 10-year low in the net non-performing asset. We have came to a decadal high in the credit growth. So you can understand that how good our foundation is. That is helping us to stand against the global spillovers, the tightening that is happening in the financial market, the volatility that is coming towards us. So this is the fortified balance sheets as well as that are providing us the good base. So these are the 2 chapters that we have already completed. Now coming to the 3rd chapter that we have to do, that is regulatory initiatives and other development in the financial sector. First we are going to see the global front, then we are going to see the domestic front. So globally what is happening, the focus is on the regulation and protecting the financial system from the spillover effect. So I will tell you that how the tightening is happening. So the inflation came due to the Russia-Ukraine war. The inflation was rising persistently due to the Russia-Ukraine war, not only in India but all over the world. In most of the countries, the inflation was rising very fast, due to which most of the economies, the advanced economies, the emerging markets, they increased their interest rate. They tightened the monetary policy. Okay, increasing interest rate means decreasing the money supply. So that is the tightening of the financial market that is happening. When the interest rate is rising in the advanced economies, you can understand that the money will flow to those economies, okay, because the interest rate are rising in the advanced economies, even though they are also rising in the emerging markets, but the money is safer in the advanced economies. This is what the investors think. So when the interest rate is rising very fast in the advanced economies, the money, the capital flows to the advanced economies. That is, the money is going out of the emerging economies, the developing economies. So money is going out of the emerging economies and in the advanced economies. So you can understand that we have the capital that is flowing out, as well as, so this is happening that the tightening of the global market is happening, due to which the capital is flowing out, the money is going out, and there is much volatility that is coming in the financial market, as well as the currency volatility was also there, because the dollar is a trusted currency all over the world. So the investors wanted to have more and more of the dollars to make their money safer. So they were buying more and more dollars, due to which the dollars was getting stronger and stronger against the other currencies. So the rupees, this was depreciating, and most of the other currencies were also depreciating. So there was also the currency volatility. So you can understand that how much problems are coming. Inflation is coming, due to which the tightening of the monetary policy is happening, due to which the capital is flowing out of the emerging markets. The capital is flowing out of most of the markets, and it is going wherever the interest rate is high. So when one monetary policy is increasing, one monetary authority is increasing the interest rate, all the money is flowing there. Then the other is increasing it, all the money is going there, all the capital is flowing there. So there is much volatility of the capital flow that is happening, and mostly it is going to the advanced economies, and there also there is much volatility, because whenever any of the advanced economies, they increase their interest rate, the money just flows out like that, okay. Then there is currency volatility also. So now what we have to do, now what the global regulation has to do is to protect the financial system from the spillover effect of the synchronized monetary tightening. All the monetary authorities, they are tightening their monetary system, they are tightening their monetary policy, and due to which the capital flow is too much. By the central banks, the monetary tightening is happening amidst a highly uncertain economic environment. The investors are also not sure, they are also are very haywire, we can say. So specifically, the global regulatory initiatives, they want to address the fragilities in the non-bank financial intermediation. So that is NBFIs. That is, we need to make this NBFIs stronger. Okay, how the NBFIs can be made stronger? By having good asset quality, by having the capital buffers. So the first focus is on the non-banking financial intermediation, that is the non-banking financial companies, we can say, because they are the one that are the most fragile. The banks, they are under the direct regulation of the monetary authority. But the NBFCs are there that are more fragile, they do not have to maintain the CRR, SLR, you can think like that, okay. So they are very fragile, and so the regulatory initiative is to boost, is to make the NBFIs stronger. And the certain segments of the financial markets need to be made stronger. The cyber risks are also coming. the crypto assets are also creating a very big threat to the regulation of the global system. Efforts are also made on the integration of the climate risk into the regulatory framework. So you can understand that there is much spillover that is happening, and now the regulatory system of the global financial system is made stronger. So what are the steps that are taken? First step, we have understood that there is much problem that is coming. Now we will understand that what are these initiatives that we are talking about one by one, so that we have the better clarity. So first initiative is enhancing the resilience of the non-bank financial intermediaries, because they are the one that are very fragile. Okay, that's why we have to make them very resilient. Okay, if we see in the Indian perspective, the NBFCs, the non-banking financial companies, they are maintaining the CRAR, the capital to risk weighted asset ratio 27.4%. So you can understand that how high capital buffers they are maintaining. Similarly, the other financial systems of the global markets also, they also have to make their non-bank financial intermediaries resilient by having them maintain higher capital buffers and having them maintain good asset quality. That is all. Okay. Next is assessing climate related financial risk are among the key priority. That is, we have to see that what are the climate related financial risks that are coming. For that, what we have to do, first of all, the Financial Stability Board has given a report on the regulatory approaches to climate related risk. First of all, the highlight is that we need to have the policy authorities to focus on identifying, gathering climate related data. That is, first of all, define that what is climate related risk that are coming. Okay, identify those risks and gather the data related to the climate data and indicators that can help with monitoring and assessing the climate risk, as well as arrive at common definitions for different risks. So first of all, we need to have the understanding of what are the climate related financial risks. Then only we can make good policies for those kind of risks. So first of all, we need to define, we need to identify, and we need to gather the climate related data, and we need to have the common definitions all over the world for the different risks that are coming from the climate related financial risks that are coming. Okay, so we need to have the common definition for the climate related financial risk all over the world. This is for the global front. Okay, next is the crypto assets and financial stability. So in India also there was much debate that how fragile the crypto assets are, how volatile the crypto assets are, and they are having more and more popularity in the traditional system. Okay, the people are very excited about crypto assets, that we will gain much profits from this. So there is much excitement regarding the crypto assets, but they are very volatile. Okay, so here we can see that the FSB, the Financial Stability Board, has proposed a framework for the international regulation of the crypto assets activities, that we have to regulate the crypto assets because they are not under any regulation, but we have to regulate them, otherwise they will create a big trouble for the whole of the global economy. Okay, for all the countries there will be trouble that will come from the crypto assets as they are very volatile. Its recommendations seek to promote international consistency on regulatory and supervisory approaches. That is, the whole of the global economy, all the countries, they should have the consistent and same regulatory supervisory approach towards the crypto assets, that is grounded in the principle of the same activity, because these are the crypto assets, so they are the same activity, the same risk is posed by the crypto assets, and the same regulation approach. So that is, they have the same activity, they have the same risk, and that's why they need same regulation. So this is the Financial Stability Board, what it has said. Now coming to the Basel Committee. Basel Committee prescribed a global minimum prudential treatment for the bank's exposure to crypto assets. Now there are many countries which says that crypto assets, you can trade in the crypto assets, you can have the crypto assets to the banks. So now the bank have the exposure to the crypto assets. Now if the bank has exposure to crypto asset and crypto went off, or we can say if the crypto is not working, then what will happen, that there is much risk that will come to the bank, because bank is directly exposed to the crypto assets. So there is much volatility in the crypto asset. So to mitigate the risk from the crypto assets to the banks, the Basel Committee has said that under the new standard, the banks are required to classify crypto assets into two groups. So these are the two groups. The group one is the trustworthy which crypto assets we trust. So these in the group asset, the crypto assets are those that we can trust in a way. That is the tokenized traditional assets. That is the traditional assets that is being tokenized. Like we can say the rupee that is being tokenized. So rupee is trustworthy, we are just tokenizing it. So it is a crypto asset that is trustworthy. Those with effective stabilization mechanism. So we are keeping the assets, the crypto assets, against which we are having the capital requirements, against which we are keeping the some capital buffer. Like I am giving you the loan, that is risky, but I am keeping some capital buffer, that is capital risk weighted asset, that is CRAR I am keeping. So it becomes more that I can handle. Okay, if I am keeping the capital buffers against the loan that I am giving. Similarly here also the capital requirement is there on the crypto assets that you have to keep, that the bank has to keep if the crypto asset become volatile and loses a lot of value. So what will happen, that this capital requirement, this capital buffer will help the bank. So these are the trustworthy, or we can say more reliable crypto assets. Now in the group 2 comes the additional risk. The crypto assets that have the additional risk, they are unbacked crypto assets. So here the crypto assets had the backing of the capital requirements. Okay, they had to, the crypto assets that have the capital requirements kept by the bank, but this crypto assets, they are unbacked. There is nothing backing these crypto assets. So if they become volatile, the whole of the bank will lose the value of the crypto asset, and there is no backing that the bank is keeping for this kind of crypto asset. So in the ongoing basis, they have to classify the crypto assets in the two categories. The banks have to do this into the following two groups, where those in group 2 will be subjected to newly prescribed conservative capital treatment. So here the crypto assets that are coming in the group 2, they will be prescribed with conservative capital treatment, that how the bank should be treating this capital, this will be defined. So effective from January 1, 2025, from January 1, 2025, all over the world, if the banks are keeping the crypto assets, they have to define that it is coming in group 1 or group 2. If it is coming in the group 2, then according to the Basel committee, they will have to follow this conservative capital treatment. Okay, so I hope you have understood this idea. Now cyber risk are also there, the financial stability, cyber risk and the financial stability. We are going to see this. So the BIS, that is the Bank of International Settlements, it has given a working paper on the cyber risk in central banking. So there is cyber risk that is coming to the central banks also, and the most kind of cyber risk that is coming to the central bank is phishing and social engineering. So the BIS working paper has highlighted that the phishing and the social engineering as the most common threat that is coming to the cyber attacks related to central banks. The BIS survey, it reveals that the central banks have notably increased their investment to have the to be secured from the cyber risk since 2020. So the central banks are the ones that are increasing their investment to have the security from the cyber attacks. Since 2020, the investment has increased a lot, giving priority to technical security control and resiliency, and focusing on developing incident response plans. So you can understand that the central banks are themselves, they have to be secure, because they have the most data of the financial system of our country, of the people of our country. So if any cyber risk come to them, if any cyber threat come to them, the threat is on the people of the country. So that's why they are doing more investment to have more technical security. Okay. So in the Indian context, the Reserve Bank has taken various initiatives to increase the cyber resiliency of not only itself but the banking system, the financial system as a whole, at both the institutional and system-wide levels. That is, for itself it is doing the cyber control, we can say. For itself it is taking steps, initiatives to be safe from the cyber threat, and for the system-wide level, for the whole financial system also, it is taking initiatives for the cyber security, including issuance of directions to supervised entities, to the regulated entities like the banks and BFCs, timely guidance on tackling emerging cyber security challenges and threats. So for itself also, the Reserve Bank of India is focusing on the cyber security, and for the system-wide level also, it is focusing on the cyber security. Coming to the domestic front, in the domestic front, the emphasis of regulation remains on improving the resilience of the financial system. We have to make the financial system strong, resilient, and fostering a conducive credit environment. The credit environment should be good so that when the credit is increasing, that means the investments are increasing. That means we have more production activities that is happening. That supports a sustainable economic recovery and economic growth and preserves the financial stability. So when the credit environment is there, when the credit growth is there, then the economic recovery is happening, we can say. So regulators undertook several initiatives, not only Reserve Bank of India but SEBI and the RBI, they took several initiatives since June 2022 because the last FSR was released in June 2022. So since then, the initiatives that were taken was in that report. Now since June 2022, the steps that is taken by the different regulators will be in this new FSR that is released in December 2022. Now the initiatives are for what? To improve the robustness and resilience of the Indian financial system, to make the Indian financial system more resilient and strong and efficient, we can say. So this is how the RBI has given the PDF. I will provide you the link for that PDF. In this you can see the RBI has just told that when something was released, what is the rationale behind releasing it, aim we can say behind releasing it. So we have already discussed that the e-mandates for recurring transactions, we have discussed about the tokenization, the card on file, the tokenization of the data. We have discussed all of this, most of this, the operationalization of the central bank digital currency, the e-rupee has been launched in the retail segment. So most of this we have discussed. The PDF I will provide you in the description box below, where you can see that what steps the RBI, the SEBI, the RBI has taken or the other regulators has taken, and this is a long PDF, but you can easily get everything here. The summary is here, that what has been launched and why it has been launched, and this will provide you a very good guidebook to see that what has happened in the country in the past 6 months. Okay, so this is in the summary form that the RBI has provided, and we have discussed most of this initiatives that has happened since June 2022. Okay, so I will provide you this PDF in the link to download it, do print it out, because it has everything that the regulators has done. So now coming to the systemic risk survey. So this is a survey and this is the risk survey that is done on November 2022. Okay, so the 23rd round of the Reserve Bank of India's systemic risk survey was conducted in November 2022 to take the perception, to have the perception of experts. Now the Reserve Bank of India and the other regulators, they have given the financial stability report, but there is market experts that are there, the economists are there, the academicians are there. They also have something to say about the economic condition. So in this systemic risk survey, we will understand the perspective of the experts, of the market experts, of the academicians and everyone. So the systemic risk survey, they have the perception of the experts, including the market participants and the academicians, on major risk faced by the Indian financial system. And according to 48 respondents, these are the risks that are coming to the Indian financial system. There are the global risk, I have told you, Russia-Ukraine war, and the COVID led to the tightening of the monetary system and everything. So macroeconomic risk are there, financial market risk, institutional risk, general risk are there. Here you can see the global risk. Here the global risk is in the high category. The major risk that is coming is from the global risk, and this has increased actually. The risk perception has increased, that the major risk will come from the global risk only. Then the financial market risk. Financial market, I have told you, it is very volatile, and that's why the risk from the financial market has also increased. This is what the respondents are telling us. Okay. Next is risk perception from the global spillovers from the global risk, we can say, and the financial market volatility grew further and remained in the high risk category. Now major drivers of the amplification, why the global risk has increased, because the monetary tightening is happening, due to which the capital flows are very high. When the capital flows are very high, there is volatility in the financial market. So monetary tightening is happening in the advanced economies, even in the emerging economies. Most of the money is flowing to the advanced economies. Geopolitical risks are there. The Russia-Ukraine war there is. Global growth uncertainty. I have told you that major international bodies, they have decreased their global growth perception, and funding risk is also there. The startups, they are not getting funding and properly. So the rise in financial market risk is there due to the tightening of the financial conditions. The foreign exchange pressure is coming. The dollar was getting stronger and stronger, and the other currencies were getting depreciated. So, and the liquidity tightening, I have told you that the money supply is being decreased. Due to this all, the financial market risk is coming, because most of the investment is now happening in the dollars, and this has reduced a lot now. But before, what was happening, that most of the investment was happening in the dollars, because dollars is quite secure and trusted by most of the countries, most of the investors, and due to which the foreign exchange pressure came, due to which the liquidity tightening was also coming, the money supply was also being reduced. Okay. Uptake in general risk. The general risk has also increased. Why? Because of the cryptocurrencies, which are very volatile, due to which the RBI has to take the step of introducing the digital rupee. The RBI introduced the e-rupee. Why? Because RBI knew that there is much volatility that will come from the cryptocurrencies. The climate change is happening, the terrorism is happening, due to which the general risk is coming to the Indian financial system. Then there are the macroeconomic risk. The decline in risk perception. Macroeconomic risk has declined. Why? Because the domestic growth is happening good. The inflation is being controlled. So decline in inflation, we have seen it has come down to 5.8% in November 2022. Capital flows are, they were going out, but they have stopped for now. Fiscal deficit, the decline in risk perception regarding the fiscal deficit, the sovereign credit rating, though the risk perception remained elevated towards the current account deficit. So for these things, the risk declined, and due to which the macroeconomic risk as a particular declined. So I hope you have understood this very well. Next is the confidence. See, the confidence in the global economy has decreased of the respondents, but they are saying that the Indian financial system, the Indian banking system will remain resilient and sound. So nearly 93.6% of the respondents remaining fairly or highly confident of the stability of the Indian financial system, though they are saying that the confidence in the stability of the global financial system declined. So in the global financial system, we do not have much trust, but in our own financial system, in our banking system, banking sector, we are saying that we are much trustworthy, that it will remain stable. Okay. Risk to financial stability, here you can see what the risk can come going forward. So it is from the volatility in the exchange rate, increase in the crude oil prices, the global economic slowdown can come, and from that the risk can come in our own economy, in the Indian financial system. The global monetary and liquidity tightening that is happening, due to that also the Indian financial system can fall in the risk. Lower corporate growth, rise in current account deficit, increased price pressures due to higher commodity prices, due to the raw material price that is increasing. The decline in corporate margins, that is the profits has declined for the corporate sector due to the raw material prices, due to the cost of raw materials, as the supply chain disruptions are happening. Geopolitical risks are coming. So due to these, the Indian financial system can fall into the risk category, but still the respondents have the belief that our financial system will remain resilient. Okay. So this is all regarding the systemic risk survey. So thank you very much. See, I am thinking of taking a revision session on the FSR and the Utkarsh, because they are very important. They both are very important. The Financial Stability Report and the Utkarsh 2.0. So in this revision session, around 15 questions will be there. So should I take this session, or you already understand everything about FSR and you remember the data very well, so you do not need such kind of session? So do tell me in the comment section below that I should take this revision session or not. Okay, if enough comments come, then only I will take this revision session. Because I think we have covered the FSR and Utkarsh very well. So if you need the revision session, do tell me in the comment section below. Do subscribe to our YouTube channel. You will get the PDF in our Telegram channel. Thank you very much everyone. If you have any query, you can mail us here or contact us through this number.